You did the one thing every financial advisor tells you to do. You paid off a loan. Completely. Early even. And 30 days later, your score dropped 42 points. This isn't a glitch. It isn't a reporting error. It's happening to you right now if you've closed any installment loan in the last 2 months, a car loan, a personal loan, a student loan, and watch the number move the wrong direction instead of the right one. Most people lose somewhere between 30 and 45 points from this. On a 700 score, that's the difference between a good mortgage rate and a mediocre one. On a 650 score, it can be the difference between approved and denied entirely. There's a mechanism inside your credit file called the credit mix ratio, and closing that loan just broke it. Nobody explains this when you sign the loan paperwork. Nobody explains it when the bank sends you that "congratulations, you're debt-free" letter either. And that silence is exactly the problem. Here's the part almost nobody talks about. There's a second reason your score can drop even harder than the credit mix issue alone, something that happens specifically when the loan you closed was older than 3 years. I'm going to show you the exact math behind that in about 2 minutes, and once you see it, it's going to change how you think about every loan you close from this point forward. Credit mix accounts for 10% of your FICO score. That number sounds small until you understand what it's actually measuring and why lenders built it into the model in the first place. FICO's scoring architecture wants to see 2 different types of credit behavior operating at the same time. Revolving credit, that's credit cards, where the balance moves and you have an open-ended limit that renews every cycle. And installment credit, that's loans with a fixed payment and a fixed end date. Auto loans, personal loans, mortgages, student loans, anything with a defined payoff schedule. When you're carrying both types responsibly at once, the underlying risk model reads that as evidence of broader financial capability. It's not measuring, can you pay a credit card bill? It's measuring, can you manage a fixed obligation over years while simultaneously handling revolving debt without either one slipping? That's a genuinely different behavioral signal in the underwriting logic, and the scoring model rewards you specifically for demonstrating both at once. The moment you pay off and close that installment loan, 1/2 of that equation disappears from your active file. If credit cards are the only thing left reporting, your mixed score compresses immediately. Not because you did something wrong financially, because the file now shows less structural diversity than it did the day before you made your final payment. So what does that actually mean for you, sitting here right now, looking at your own report? It means the exact action that felt like the responsible, disciplined, financially mature move, paying off debt completely and on time, can cost you real points on paper, even though your actual financial position objectively improved the day you made that final payment. This is one of the most common blind spots in consumer credit, and it isn't something your loan servicer has any incentive to mention to you. They're not required to explain scoring mechanics as part of the payoff process. They're required to process your final payment and close the account correctly, generate the payoff letter, and update your balance to 0. What happens to your score after that point is simply not their department, and it's rarely anyone's department to tell you, not the lender, not the bureau, and certainly not the bank that just congratulated you. Here's a specific comparison worth sitting with for a second. A borrower holding 1 credit card and 1 auto loan, both in good standing, typically sits in a stronger credit mix position than a borrower holding 3 credit cards and 0 installment debt, even when that second borrower carries a lower total balance across all accounts. The type of debt you're carrying matters almost as much as the amount, and almost nobody structures their accounts with that in mind. This is also why you'll sometimes see 2 people with nearly identical income, nearly identical total debt, and completely different scores. It's rarely about how much they owe. It's about what shape that debt takes across their file. Now here's the part I mentioned at the start, the mechanism that makes all of this measurably worse, specifically for older loans. When your installment loan closes, it doesn't just quietly leave the active accounts section of your report. It moves into your closed account history, and exactly how it gets weighted there depends heavily on the loan's age and its payment history leading up to closure. A loan that stayed open for 3, 4, or 5 years and was paid consistently on time was doing something else important. The entire time it remained active, it was pulling your average account age upward, and average account age is 15% of your score on its own, a separate factor entirely from credit mix. Length of credit history looks at two specific things: the age of your single oldest account and the average age of every account combined across your file. A 5-year-old auto loan sitting open in your report was pulling that average upward every single month it remained active and reporting. The instant you close it, that account eventually stops being weighted the same way inside your active average. It doesn't vanish from your report immediately. Closed accounts in good standing typically remain visible on your file for up to 10 years, but the scoring models increasingly weight open, currently active trade lines far more heavily than closed ones when calculating your present-day risk profile. That's the compounding mechanism working against you. You're not simply losing 10% of credit mix in isolation. You're also softening part of the 15% tied to account age at the exact same moment, triggered by the exact same single action. Two separate scoring factors moving in the same direction from one payoff. Run the actual math on that for a second. A borrower closes a 5-year-old auto loan they paid perfectly for 60 consecutive months. Two separate scoring factors shift downward in the same moment from a single loan. That combination is precisely how a 42-point drop happens to someone who did absolutely everything right. What I'm about to show you next is the part most people never find. Let's stop here. This is the calculation that changes what you actually do about all of this. This exact pattern is happening right now to people applying for mortgages within 6 months of getting a home, and it is costing them real, measurable money. A 100-point difference in score can shift a 30-year mortgage rate by half a percentage point or more, depending on the lender's rate tier structure. On a $400,000 loan, half a point of rate difference is worth over $40,000 in additional interest paid across the full life of that loan. Almost nobody connects "I paid off my car 6 months ago" to "my mortgage rate came in higher than expected." But the underwriting matrix connects those two events instantly because the lender is pulling your score after the mix compression has already fully settled into your file. There's a reason code system lenders use internally to document adverse decisions on paper, and lack of recent installment credit or insufficient credit mix is a genuine standard reason code that appears on adverse action notices far more often than most people ever realize. If you've ever been quietly surprised by a denial or a worse rate than you expected arriving shortly after paying something off completely, this could be exactly why. You likely never received a clear explanation connecting the two events. Let's walk through a realistic version of this so the mechanism stops feeling abstract. Someone finances a car for $36,000 over 6 years. They make every payment on time. Somewhere around year 4, they come into some money, a bonus, an inheritance, a tax refund, and they decide to pay off the remaining balance in full. It feels like the obvious right move. Less interest paid, one less bill every month, debt-free ahead of schedule. 2 months later, they start shopping for a house. Their score comes back lower than the number they'd been tracking on their banking app for the past year. The loan officer mentions the rate tier they qualify for isn't the one they expected. Nobody in that conversation mentions the auto loan payoff. Nobody connects it. The homebuyer walks away, assuming the market simply shifted, or that mortgage rates in general had moved against them, when in reality a specific, identifiable, and largely temporary drop in their own file was doing most of the work. This is the exact scenario the using code system is quietly documenting every day, and it almost never makes it into the conversation the borrower actually has with their lender. Here's the calculation worth running twice because the first time through it doesn't quite land. Say that homebuyer's score sits at 730 before the payoff and drops to 688 after, a 42-point move consistent with what we've been describing. Depending on the lender's specific rate tier structure, a borrower in the 720 to 739 band might qualify for a rate meaningfully lower than a borrower sitting at 680 to 699. On a conventional 30-year mortgage, that tier difference alone, separate from any broader market movement, can run somewhere between a quarter and half a percentage point. Half a percentage point on $400,000, amortized over 30 years, works out to roughly $42,000 in additional interest paid across the life of that loan. 42 points costing roughly $42,000 is not a coincidence worth memorizing as a universal ratio. The real math shifts by lender, by loan size, by rate environment, but it is close enough.
often enough that it's worth internalizing as a rough mental benchmark. A meaningful chunk of change from a single payoff timed 6 months before the wrong application. This is also precisely why sequencing sits inside the same category as timing the statement closing date or managing your utilization percentage before a big purchase. None of these mechanics are about avoiding debt responsibly managed. They're about understanding that a credit file is read at a specific moment in time. What that file looks like in that specific moment matters more than what it looked like a year earlier or what it will look like a year later. There's an underwriting matrix most major lenders run behind the scenes that weighs recent account activity more heavily than older, stable activity. That's a deliberate design choice, not an oversight. Lenders are trying to answer one question above all others. What does this borrower's financial behavior look
like right now, in the months immediately preceding this application? A payoff that happened 18 months ago has largely faded from that recency weighting. A payoff that happened 6 weeks ago is sitting directly inside the window the model cares about most. So here's what actually protects you going forward, and it isn't what most people instinctively assume the fix should be. The natural instinct is to conclude you should never pay anything off early again. That's the wrong lesson to take from this. The correct move is sequencing, understanding precisely when, in your broader financial timeline, you choose to close an installment account, especially relative to any major application you're planning within the next several months. If you're planning to apply for a mortgage, an auto loan, or any significant new line of credit within the next 6 months, do not close an existing installment loan early during that specific window if you have any flexibility on timing. Let it finish its natural remaining term, or at minimum, delay the full payoff until after your major application has already closed and any new trade line has had time to report. The mix compression matters most precisely when a lender is about to pull and evaluate your file. If you've already paid off the loan and you're not applying for anything in the near term, the damage here is genuinely temporary. Scores typically recover within 3 to 6 months as your credit mix naturally rebalances, especially if you're maintaining even one other active trade line, even a single credit card used responsibly, reporting a healthy utilization ratio below roughly 10%. If your current mix shows 0 installment accounts and you're planning any major purchase within the coming year, consider deliberately opening a small credit builder loan specifically to reintroduce installment credit into your file ahead of time. These typically run between $200 and $1,000, report monthly to all 3 bureaus, and exist specifically for this exact scenario. It's a deliberate, low-cost way to rebuild the mix factor well before you need the score without taking on any meaningful financial risk in the process. There's a second option worth knowing about if you're not ready to take on new debt at all. Some credit unions offer what are sometimes called share-secured loans, where you borrow against your own savings account, pay yourself back over 12 months, and the on-time payments still report as active installment history to all 3 bureaus. You're essentially borrowing your own money back at a small interest cost, typically under $50 total, purely to keep that second scoring factor alive while you decide on bigger financial moves down the road. These products exist specifically because credit unions understand this exact gap in the scoring system. They're inexpensive, low-risk, and specifically designed for people in precisely your situation, someone who paid off debt responsibly and now needs to rebuild one specific factor without taking on real financial exposure. Ask your credit union directly whether they offer one. Not every branch advertises it prominently, but most larger credit unions carry some version of this product on their books. Check your own report right now for this specific pattern. An installment account marked closed within roughly the last 90 days, paid in full, sitting at a 0 balance. If you're seeing a score drop in that same window with absolutely no missed payments anywhere else on your file, this is almost certainly your answer, not an error and not something worth disputing with the bureau. I used to assume that paying something off early was always, unconditionally, the financially correct move in every situation. This is one of the very few scenarios in the entire credit system where the timing of a payoff genuinely matters more than the payoff itself. Here's a question worth sitting with for a moment. What's one piece of financial advice you followed exactly as instructed, precisely as told, that ended up quietly costing you in a way nobody ever warned you about ahead of time? Drop it below. I read every single one. If this gave you something real that you didn't have walking into this video, subscribe. There's a lot more of this coming every week. Next, I'm going into exactly what lenders actually see when they pay for your file, the internal version of the credit report that never once reaches your phone or your app screen. It includes overlays, internal risk tiers, and reason codes that shape every major decision made about you, and almost none of it is visible from the consumer side.
The gap between the number you check and the number they actually use is going to be more surprising than the 42 points we just walked through together.